Hello everyone, it's Jefford again from Rubik's Academy. Okay, so today we are looking at one of the more important we're going to look at for the next few lessons. We'll be looking at technical analysis, what technical analysis comprises of, and what it means to a new beginner like yourself to the stock markets. Okay, we're going to go a bit in depth on what technical analysis comprises of, what are some of the tools that you can use, so on and so forth. But I think the most important thing to first understand, even before we go into all the tools and all the indicators, all the aids that you can utilize to help you analyze the chart, I think it's important to first talk about the chart itself. Okay, it's important to first talk about the chart. We need to set the foundation first, right? So to talk about the chart, it is inevitable, it is unavoidable that we talk about this thing called candlesticks. Okay, we talk about this thing called candlesticks. Now, what are candlesticks? Later we will go on to the live chart, but basically once you go on to a live chart, you will see that on the live chart there are all these rectangles that is on the chart. Okay, each of these is called one candlestick. Okay, and together they are called candlesticks. Okay, now what do these candlesticks represent? They basically represent the price. They represent the pricing unit of that particular asset, or to put it in a more simple and concise form, they represent the price of the specified asset. The specified asset could be stocks, could be FX, could be commodities, could be an index, could be precious metals, I don't know. Alright, but basically candlesticks represent the price. Okay, now it's important to understand how these candlesticks work so that you understand what the chart is all about. Okay, and of course, like I said, this is the beginner's edition, so if you are not a beginner, this would all look very, very familiar to you. This is the basics of the basics. Okay, now a candlestick is basically price movement. Alright, the reason why a candlestick is probably the best representation of price is because not only does it take into account the current price at that point of time when you open the chart, it also takes into account where the price has gone to, where the price has retraced to. It basically is like a journal. It is a journal of where that price has been. Okay, where that price has been in a given period of time. Now, each candlestick represents price, right? But when I say in a given period of time, how long is that period of time? Is it 5 minutes? Is it 10 minutes? Is it 1 hour? Is it 2 hours? Now, all that depends on the time frame of the chart. So, here are a few time frames. Usually, it's divided into M1, which is 1 minute. When I say 1 minute, it means that each candlestick that you are about to see on the chart is there for 1 minute. After 1 minute, the current candlestick will stop moving. It will become stagnant and the next candlestick will appear. That is how a series of candlesticks appear together, and together they tell the story of where the price has been. Alright, then there's also M5, which is 5 minutes. Then there's M15, which is 15 minutes. There's M30, which is 30 minutes. Then after that you have H1, which is 1 hour. Okay, you have H1. Then you have H4, which is 2 hours. Okay, then usually after H4 you have D1, which is daily. So each candlestick lasts for a day before that current candlestick closes and the next candlestick opens. Then you have weekly. So each candlestick lasts for a month. Okay, then you have 1M, not to be confused with M1. 1M is monthly. Okay, so depending on the time frame of the chart, the candlestick will survive for that given period of time. And once that given period of time is reached, that candlestick will close and the next candlestick will open. Alright, and that's how all the candlesticks come together to tell a story of how and where the price has been. Now, a candlestick is broken down into several parts. Okay, let's say this is a candlestick. Okay, it is broken down into several parts. Number one, you have the opening price. Okay, then you have the closing price. Okay, then this thing over here, we call it the candle body. Alright, then you have the low, and then you have the high. Okay, and then you have the candle wick. This is called the lower wick, or it's sometimes also called candle shadow. This is called the upper wick. Okay, sometimes it's also called the candle shadow. Now, it's important to understand all these different parts and what they mean. Okay, so these are the different names and different labels for a structure of a candlestick. But what exactly do they mean? Okay, it's actually pretty simple. Alright, so when a candlestick opens, it opens at a certain price. Let's say this is $5. Okay, so at that point, the asset's price is $5. Now, if let's say from $5 it goes up to $6, then you will see the candle body form. Alright, and the candle body will be formed because now the price has moved up to $6. So the candle body represents the difference in price between $6 and $5. Simple, right? It's just a region there to represent the difference in price. Then of course, if it continues to go up, then you can go up to $7. Then you see the region get wider, get bigger. Alright, but let's say from 7 USD it comes back down to 5 USD. Then what will happen is, to reflect this retracement back down to $5, what will happen is the candlestick will show a candle shadow. So instead of a region, it will be marked by a line. And that's why we have the candle wick. Okay, and since this region was above the starting price, we call it the upper wick or the upper candle shadow. Alright, then if let's say at $5 it goes down to $3, then a region will be formed as well, but this time the region will be below the starting price, because now instead of going up in that given period of time, price has come down. Right, at $3. Okay, so let's say it doesn't stay at $3. Okay, let's say the candle ends with going back to $5. So the candlestick will end looking like that. $7 USD will be the high of the candlestick. Okay, $3 USD will be the low. And of course, 5 USD will be the opening price. Okay, and in this case, the opening price is also the closing price because it opened at 5 and it went back to 5. Alright, simple. This is in summary the lifespan and the transition process for a candlestick. Now, how long does this last? How long does it last from going from this to this? How long is this process? Now, the time of this process is determined by the time frame of the chart. Time frame of the chart. So if the time frame is, let's say for example just now M5, then this process will be 5 minutes. If the time frame is M15, then the process will be 15 minutes. If the time frame is H1, then it took 1 hour to get from here to here. Okay, so it depends on the time frame of the chart. Okay, now with that being said, let's go to an actual chart to take a look. All right, let's go to the chart. Okay, you guys can see the chart right here, right? So let me just zoom in a bit. Okay. Okay. So each of these, let me just draw it out. Each of these is called a candlestick. All right. Each of that is called a candlestick. So you can see that price went up, then it came down. All right, went up, came down, went up all the way. So you can see that different candlesticks have different colors. So the white candlestick represents what we call a bull candle. A bull candle is where the closing price is higher than the opening price. Then the red candle represents a bear candle. A bear candle is where the closing price is lower than the opening price. The only difference between a bull candle and a bear candle is the story of the pricing, right? In a bull candle, in that particular candlestick, within that 5 minutes, within that 15 minutes, depending on the time frame of the chart, prices went up. For a bear candle, within that given time, prices came down. That's all. Okay, and you can see for this particular chart, the time frame is 4 hours, H4H over here. All right, and you can see for TradingView, they offer from 1 second, which is what we call 1 tick, to 1 month. All right, ignore the ranges. Okay, so let's not talk about ranges because I don't want to confuse you, but just make sure that TradingView offers from 1 second to 4 hours. Oh, sorry, to 1 month. Okay. All right, that's it for this lesson. Thank you very much. My name is Jefford Lim from Rubik's Academy. Make sure you follow us, subscribe to our channel, download our mobile app. We have a lot of other experts that are from other organizations specializing in other fields on the app for you to consult them and for you to be trained under them. Okay, thank you very much. My name is Jefford Lim from Rubik's Academy. Thank you.